Welcome back to this week's market update. Today is Friday, November 10th, 2023, and we will jump right in here. So this week was a bit quieter compared to last week's Fed meeting and next week's CPI print, but we do still have some updates here. And when we look at what the market did, we saw the NASDAQ composite gain about 0.3% on the week, the S&P 500 lose about a quarter percentage point on the week, and the Dow Jones Industrial Average lose about 0.5% for the week after last week's gains. Looking forward through this week's economic data, we got the consumer credit data for the month of September here from the Fed, showed a 2.2% increase in total credit from a year ago, which was led by a 2.9% increase in revolving credit, which includes things like credit cards or lines of credit, where consumers and businesses really only tap into when they need that cash flow. This is quite a bit of an increase. However, it is quite modest compared to the last few months where we saw, double digit, high single digit numbers on a year-over-year basis. Other recent data indicates that the average credit card balance is now over $6,000, which is the highest level since 2013, according to TransUnion. Additionally, we saw this week the Federal Reserve Bank of New York release data showing a record total credit card debt for the third quarter of $1 trillion, over $1 trillion. So really interesting. All of this comes at a time where job markets are pretty robust still and debt levels are not really crushing households whatsoever. However, this could definitely pose a threat if a recession were to occur and employment takes a hit. Another perspective I like to look at consumer credit here is the delinquency rate on credit cards. And you might have heard in the news that there's a huge increase in delinquency rates, which is true. We've gone from this below 2% level to almost 3% here. But when we look historically, it's really returning to kind of pre-pandemic levels, that sub 3% level there. And it's nowhere near where the great financial crisis was, where the tech bubble was. And honestly, it's been pretty much in a low level over the last decade or so compared to where we were from 1990s through the early 2000s here. So nothing of concern in terms of household debt for now, but we will continue to keep an eye on it. Moving along through this week's data, we got the Consumer Sentiment Index for the month of November here from the University of Michigan, showed a 5.3% month-over-month decline, marking the fourth month of monthly declines here, but this was an increase of 6.5% from a year ago. We also saw the same trend in current economic conditions and expectations, where it decreased on a monthly basis, but increased compared to a year ago here. So interesting stuff there. Throughout the survey, we also saw that consumers continue to express their concerns on higher interest rates, particularly in their ability to buy bigger ticket items here, like homes, like cars, like other durable goods. And here you can see almost 70% of consumers listed higher interest rates as a reason for not being able to buy quite as much. So really interesting stuff as we look at how consumers are feeling and acting in this economy. So those were the primary updates of this week in terms of new economic data. However, we did get quite a few more companies report quarter three earnings here, and you can see 92% of the S&P 500 has reported earnings, with 81% of those companies beating estimates on that EPS basis. On a year-over-year basis, we have seen a 2.1% increase in revenue compared to 2022 and a 3.4% increase from quarter three of last year in earnings. So overall, a lot better than expected. Initially, at the beginning of this earnings season, we saw analysts extremely bearish on the S&P 500's earnings, with most estimates pointing to the index showing a decline in sales and earnings compared to a year ago. Another really interesting thing here, we want to look at the sectors that have had the greatest earnings growth. Consumer discretionary, which is extremely interesting in an economy where, most thought we would be in a recession by now, as well as communication services, up quite a bit as they trim their expenses and really hammered down on that bottom line growth. We also saw financials, which again, interesting in this higher interest rate environment, and cyclicals experienced quite a bit of earnings growth compared to a year ago. So overall, we've seen Q3 earnings season come out a lot better than expected, and we will continue to monitor for any few last reporting companies. As we had a bit of a quieter week in terms of economic data, I wanted to take a few minutes to look at kind of where we are in terms of recessionary data. Are we in a recession? Are we working towards a recession? And honestly, the truth is that we thought we would be in one by now, according to a lot of estimates, and we are not. So the outlook for a recession looks to be a bit slimmer of a possibility, maybe a little bit further out and a little bit of a more shallow recession than we had originally thought, according to the data right now. But again, subject to change in the course of just a few data points. So here, one really important indicator of an economic downturn is the 1-year change of employment, the unemployment rate here. And a lot of this has to do with pandemic reasons, having this incredible unemployment rate up in the beginning of 2020 and how we have had such a slope since then, slope down. But we have seen since the early bit of 2021, we have seen a gradual increase of unemployment since then. And again, a lot of this is really unnatural unemployment from the pandemic and kind of recovering to more normal levels, but we are at a 3.9% unemployment rate, which is an increase from a year ago. We'll continue to watch and see if this employment rate continues to increase on a year-over-year basis. Also, as we look at the probability of a recession here, you can see the mean probabilities for real GDP growth in 2023, according to the Federal Reserve of Philadelphia here by a survey of professional forecasters. You can see that the previous survey, which was about first half of the year compared to the third quarter survey, has moved quite a bit. So here you can see the odds that GDP totals a positive rate of 1.5 to 2.4% growth year over year has moved up significantly. Actually, its majority now broke above 50% of a probability for 2023, especially as we had that really strong third quarter GDP report. So it looks like in the fourth quarter of 2023, we are very unlikely to have a serious decline in GDP that puts us into a recession, according to data like this. But we'll continue to watch, and then we'll look here at one final thing, the yield curve, and see how that plays into the possibility of a recession. As I was just saying, a final indicator of a recession to come is pretty accurate historically is the yield curve, the 10-year minus the 3-month US Treasury spread. So historically, you can see dips below zero quite a bit, and then it goes up right before these gray lines, these recessionary periods. And you can see here again in the early 2000s, dips below zero and de-inverts and becomes positive here, then a recession. And that's really what we're seeing right now. So here you can see we've dipped in about June of this year, and we've been coming up here as rates have been moving quite rapidly. And again, the Fed has never hiked rates as fast as they have in this current cycle. So none of this can be really taken for certain. However, it is historically pretty much a telltale sign of a recession to come. So do we still believe a recession is on the horizon? Probably yes, but definitely is going to be further along and possibly shallower than initially thought. Thank you so much for tuning into this week's market update, and we look forward to providing another update next week.